Welcome to Module 8, guys, where we'll dive into the most popular structures to invest in property. Choosing the best ownership structure for your investment property can save you thousands of dollars in tax and protect your personal assets in the case of bankruptcy. Everybody has their own opinion on what structure should be used, but everyone's situation is different. You need to seek advice from an accountant, and it's best to have all this sorted and set up before making any offers on properties. It is crucial that you understand the different structures and set it up correctly from the start, as it can be difficult to untangle the wrong structure with huge costs involved. The most popular tax structures to invest in property are individual ownership in your name, joint ownership with a partner or spouse, a joint venture, a family discretionary trust, a unit trust, a self-managed super fund or SMSF, a company, or a property syndicate, which is another option that would be beneficial, and we'll look at that at the end of today's lesson. We're going to look at each of these in more detail, starting with individual ownership or buying in your own name. Individual ownership. Investing in your own name is the simplest and most common method for property investing. It requires no setup cost and minimal compliance is required. The main benefit of buying in your own name that gets discussed a lot is the ability to gear the property if there are any losses negatively. However, this is more important with residential property, as commercial property is usually cash flow positive and negative gearing is not particularly beneficial. On the downside, you could lose the property if you become bankrupt or sued, even if the debt is unrelated. This structure is suitable for new property investors and those not concerned about bankruptcy risk. Next, we have joint ownership. Similar to individual ownership, however, you have to decide on the percentage of ownership and whether you are joint tenants or tenants in common. Joint tenants hold the property equally, so husband and wife would own 50% each. The income or losses of the property are split equally and added to the two partners' individual tax returns. If one joint tenant dies in this structure, the property will automatically pass to the surviving joint tenant. The other option is tenants in common arrangement, which means you decide the share that each partner owns. This could be a 50-50 split, but it could also be an 80-20 split. As commercial property is generally positively geared, this setup can help with tax if you allocate a larger portion to a lower income partner. If you know the property will be negatively geared, you will allocate a larger share to the partner with the higher income to maximize the tax deduction benefit. When considering this structure, consider your personal circumstances and the impact of any future capital gains from the sale. Another difference is that if one partner dies, the share does not automatically go to the surviving partner, but will be passed down as per their will. Our third structure is a joint venture, which involves two or more individuals buying the property. These could be friends, family, or business partners. In this case, you should think of it like you are entering a long-term relationship, and all terms of the agreement should be in writing to avoid any legal issues later. It is important to have an exit strategy, as an individual's financial and personal circumstances can change at any moment. Each buyer should have separate loans. That way, if one partner struggles to make payments, your credit history or borrowing capacity won't be affected. Even if the joint venture runs smoothly, separate loans means only your portion of the loan will count towards your ability to service another loan. Without a separate loan, you'll be assessed for the entire debt, even though someone else is paying half, and this can seriously affect your borrowing capacity and potential future purchases. When buying as a group, there is always the potential for conflict or differing opinions. Everyone must have the same goals and ideas on how the property will be treated over time and what the exit strategy is. For example, will you sell the property in a short time or hold it long term? Maximize the loan to value ratio in order to hold less capital in the deal, or maintain a modest LVR to maximize cash flow? Will you refinance the property at the earliest opportunity or pay down the loan over time? Will you add value to the property by injecting capital or spend less to have a higher short-term cash flow? One key to a successful joint venture is ensuring that each member spells out their goals and a contract is drawn up to ensure everyone is protected legally. There are a lot of stories about joint ventures going wrong, so make sure everything is above board and written down to avoid any potential issues. Let's move on to family discretionary trusts, which involved an arrangement where assets are held by a trustee, which can be an individual or company, with the intention that the benefit of the asset be transferred to the beneficiaries. You don't need to specify the share of each spouse and family member, but have the flexibility to distribute income in the most tax-effective manner from year to year. A trust also protects assets, especially when you have a company as a trustee, and allows you to carry out estate and succession planning. Another positive is that trusts are still eligible for a 50% discount on capital gains tax. This is a popular structure for a lot of investors, but there are some negatives. They are costly to set up and have higher compliance costs for tax returns each year. You also can't distribute losses, meaning they aren't suitable for holding negatively geared properties. Another type of trust is a unit trust, where the trustee divides the property into fixed and quantifiable parts called units. Beneficiaries subscribe to these units similar to how shareholders subscribe to shares in a company. The money or property from the trust is distributed in fixed portions to the beneficiaries according to the number of units they hold. This certainly makes unit trusts more appropriate than discretionary trusts when third parties who are not family members are investing together. Other benefits of a unit trust include asset protection, as well as estate and succession planning. Again, this trust is also eligible for a 50% discount on capital gains tax. Self-managed super funds, or SMSFs, have been increasing in popularity and are used when individuals want to have control of their superannuation assets. Due to the high cash returns, many buy commercial properties in this structure. Setting up a self-managed super fund is costly, and it takes a lot of preparation and constant management to ensure regulations are being met. The biggest benefits of this structure are the tax benefits, which include: once the individual retires, they pay no capital gains tax. Loan repayments can become tax deductible, provided members' salary sacrifice. The income of the property, after expenses and any capital gains on the disposal of the property, is taxed at a maximum rate of 15%, compared with up to 46.5% of regular investor could be paying. Superannuation contributions given by your employer can be used to help repay any loans associated with the property and can be protected against general debt recovery or bankruptcy proceedings. On the negative side, the benefits of a self-managed super fund generally can't be accessed until you retire or reach preservation age. Many complex rules are also constantly under review, so a thorough understanding and ongoing attention is required. Another point to note is that any tenants in a self-managed super fund property must be third party and not related to you. As this is such a popular structure with a lot of detail and questions, we've created a whole lesson dedicated to unpacking the self-managed super funds. That lesson is coming up next. The last of our most popular structures is purchasing with a company. A company is a legal entity in its own right. When you borrow in the company's name, it will own the investment property. The company will be the borrower, and all the directors of the company will be required to guarantee the loan. Some benefits of buying under a company structure are a lower tax rate and the ability to plan tax through dividends. Any tax the company pays can be passed to the shareholders through franked dividends, which means shareholders get a credit for the company tax already paid. You'll also receive a higher level of asset protection as the asset is owned by the company. Financing is usually harder for a company due to the banking restrictions and higher risk. You also risk losing your property if the company is sued. Like some of the other structures, a company structure's setup and maintenance costs are costly. A big downside is that companies aren't eligible for the 50% discount on capital gains. Additionally, a company cannot distribute losses, so it is not suitable if your property is negatively geared. Although, as a director, you are not personally liable, another issue is that you'll be legally obligated for responsibilities such as ensuring solvent trading. Let's look at another option you may not be familiar with: a property syndicate. Property syndicates pool funds from many investors to acquire commercial property for everyone's benefit. They offer qualified, sophisticated investors the opportunity to part own high-quality, expensive commercial real estate that is usually out of reach. Syndicates also allow investors to be more passive with the tenancies and management of the property. So why doesn't everyone just do this? Well, not everyone can access a property syndicate. You have to be deemed a sophisticated investor, defined in the Corporations Act as a professional investor. This structure is not for new or inexperienced investors or low-income investors. To qualify as a sophisticated investor, you need a signed Sophisticated Investor Certificate from your accountant confirming that you own assets equal to or more than 2.5 million, or that you earned more than $250,000 in the last 2 financial years. However, if you invested more than $500,000 in a syndicate offering, you are not required to provide this certificate. A syndicate is legally structured as a unit trust, with investors applying for units in the trust. As mentioned earlier, a unit trust has many similar characteristics to a company. However, syndicates are usually only established for a finite period of around 5 years. After that, it is intended that the asset is sold, but this is not mandated. Syndicates guarantee that the unit holders can cash out their investment after 5 years, whether or not the asset is sold. The trustee does hold the right to sell the property before 5 years if they consider it in the unit holder's best interest. The syndicate's trust formation and management are delegated to an associated company. They handle finding the property and negotiating the purchase, performing due diligence, organising financing arrangements, maintaining all financial records, and dealing with real estate agents, property managers, tenants, and maintenance contractors. All the day-to-day running of the affairs allows the investor to be passive with the property, though this also means you have less control of the property. The syndicate operators are required to hold an Australian Financial Services licence. These licenses are tightly regulated and the company will be audited annually, ensuring compliance with all of its legal and statutory obligations. Each unit trust and licensee manager's affairs and finances are also audited individually every year. Just like any other trust, there is an agreement that outlines the terms and conditions of the relationship between all parties involved in a property syndicate. This agreement often includes a term called the objective, which basically states the reasons why the property syndicate was created. Typically, this objective or goal is shared among all the members of the group. In summary, a syndicate is a way to invest in many properties without owning them completely. For the right investor, it allows them to purchase expensive, large-scale commercial real estate that otherwise would be out of their reach. Syndicates can be organised privately between investors or specialist companies. Just like any of our buying structures, there are pros and cons with a syndicate. Let's take a look at some of the benefits and associated risks now. Firstly, the benefits include less capital required. So investors are able to buy a high value property with less capital as there are multiple investors. Diversification, which means you need a smaller outlay to spread the risk over multiple properties. Stable returns. By diversifying your assets, you can regulate your returns and have less volatility. Time saving. There is less effort required than acquiring and managing a property yourself. Also, there'll be less time on the management and administration. Now, let's have a look at the risks or drawbacks to a property syndicate, which include less control. With there being more investors, you will have less influence on the decisions. Other vested interests and transparency. The other financial investors' goals and wishes have to be taken into consideration. They may keep their intentions hidden, and at any time, their goals and personal and financial situations may also change. Management issues. Investing in a syndicate requires trust in the management team as they have day-to-day control over the property. Seeking regular updates can help avoid potential issues here. As you can see, there are some different buying structures to use for property investment. The key takeaway from this module is to set up the correct structure from the beginning. Talk to your broker and accountant and get good advice from trusted professionals before considering placing offers on properties. Making sure you get it right from the start is crucial. Otherwise, there may be huge risks involved, such as paying stamp duty again. You also want to be prepared to move fast when looking at a property in a hot market. You want to sign a contract ASAP when you start looking, so your buying entity needs to be set up before you get started. Thanks again, guys. See you on the next lesson. Welcome to your next lesson, where we'll be focusing specifically on self-managed super funds, or SMSFs. We touched on SMSFs last lesson, but let's drill down on exactly what it is and why would people create their own. Well, an SMSF simply allows you to manage your own superannuation investments for your retirement. Most people create this fund to gain control over their financial future and not leave it in the hands of someone else. Because Who else would care more about your retirement than yourself? The common way of thinking about our retirement has been for our employers to make compulsory super contributions to our fund while we go about our lives and let it run itself. We wait until retirement age, then we either take out the lump sum or draw down a percentage to live off. Can anyone see a potential problem with this? With people living longer, inflation often means we have to cut back in retirement and budget rather than live the life of retirement we deserve. Sometimes you may even run out of money at a critical time when you need it for healthcare or a retirement home. So how do we ensure this doesn't happen? We make our money work for us instead of just letting it sit there until we're at least 60. Let's take a look at what the structure looks like and how it works. It is important to have your self-managed super fund structure in place well before buying an investment property. Of course, you need to speak to your accountant before setting anything up. First, you will set up your self-managed super fund with a corporate trustee, a company that acts as a trustee for the fund. You can then transfer your super from your industry fund into your SMSF. Now, this is where it can get a bit tricky to understand. But basically, trustees of a self-managed super fund are prohibited from borrowing under the Superannuation Industry Act, with the exception being a limited recourse borrowing arrangement or LBRA. The main benefit is that in the event that something happens and you can't pay your mortgage, you're liable to sell the property you purchased while other assets in your self-managed super fund are protected. To get around the borrowing rule, a separate trust entity called a bare trust, which is essentially an empty trust, is set up to own the property on behalf of the self-managed super fund legally. This will be set up with a custodian trustee. The SMSF is the beneficiary of that trust and will make repayments on the loan. This bare trust essentially just holds the property and its income until the loan is repaid. Once the loan is paid off, the entity is dissolved and the property returns to the self-managed super fund. The bank will be looking at your contributions, your deposit, the property and the tenant, and the property's longevity to meet future repayments. For the lender, an SMSF loan is a higher risk, so they want to ensure the property is a solid investment. This is where commercial property works great, as the banks love to see a highly cash flow positive property, and the loan pays itself off faster than residential. As we have said in earlier lessons, putting a portion of the cash flow into a buffer for security is important. If you need to re-tenant your property, your buffer will mean you can still make repayments to the bank. If you are short of liquid money in your self-managed super fund and cannot make repayments, there are a lot of compliance issues. This could mean your SMSF is shut down or suspended, which can be costly to rectify. In summary, the aim of investing in a self-managed super fund is to create a better and hopefully sooner retirement. A great way to do this is through investing in commercial property. Now, let's go into more detail on the advantages of using a self-managed super fund to buy commercial property. 1. Tax planning and advantages. You are only required to pay 15% income tax on the rental income from your self-managed super fund property. This is well below the marginal tax rate, which can get up to as high as 45%. Whilst you may be ready for retirement sooner than 60 years of age, this is where tax benefits really kick in. If you sell your property in the self-managed super fund after this time, your capital gains are tax-free. There's also no tax on the income you get from your SMSF. So, for example, if you're retired and you're pulling $100,000 each year out of your self-managed super fund once you are 60 and older, then guess what? No tax. That is almost equal to earning $140,000 pre-tax while working full-time. How good is that? 2. Borrowing. Using leveraged and borrowed funds can increase your investment capacity and allow you to acquire property you might not be able to afford outright. SMSF can potentially give you additional borrowing capacity even if you're maxed out borrowing capacity outside of super. 3. Greater control. You can choose and manage your investments, including shares, property, cash, and other assets based on your risk tolerance and financial goals. You can choose what specific properties to invest in and the timing of buying and selling. 4. Asset diversification. Adding property to your SMSF investment portfolio can help diversify your holdings and reduce risk. Diversification can potentially protect your retirement savings from the volatility of the stock market and provide stable income stream from rental payments. 5. Pooling family resources. Self-managed super funds allow up to 4 members with some exceptions, so it can be a great way to pool family resources and working towards a shared retirement goal. 6. Estate planning. Holding a property in a self-managed super fund can provide estate planning benefits. Upon your passing, the property can be transferred to a beneficiary with certain tax advantages, helping to preserve your wealth for the next generation. Of course, just like any other structures, investing in property through self-managed super fund does come with responsibilities and potential risks. Let's touch on those. 1. Regulations and compliance. Self-managed super funds are subject to strict regulations and compliance requirements set by the Australian Tax Office, or ATO. Failing to meet these requirements can result in penalties and even loss of the self-managed super fund's concessional tax treatment. 2. Liquidity and accessibility. Property is a relatively illiquid investment, meaning it might take some time to sell and convert into cash. This can limit your ability to access your funds in the case of unforeseen financial needs. 3. Market risks. Like any investment, property values can fluctuate based on market conditions. There is no guarantee of capital growth, and property prices can go up and down as well. 4. Costs and fees. Managing a self-managed super fund, including property investment, involves various costs such as legal fees, property management fees, maintenance costs, and self-managed super fund administration fees, which can become expensive. 5. Expertise required. Managing a property investment requires knowledge of property markets, rental management, property laws, and more. It is important to have the necessary skills or to work with professionals who can assist you. Before deciding to buy any property in a self-managed super fund, always seek legal and financial advice from those who specialize in this area. An accountant, tax agent, or an administrator is usually enlisted to help the fund meet its reporting and admin obligations with the ATO. And a legal practitioner is often asked to advise on setting up of the trust deed. Your team can then help you create a strategy that aligns with your goals, risk tolerance, and overall retirement plans. So, now we know the benefits and risks of buying a property in self-managed super funds. Why exactly is commercial property such a great idea? Mostly because it is cash flow positive from day one. The rationale behind super is accumulation, so there are some rules around the properties you can buy and what you can do with it. If your intention is to renovate, flip, or develop a property, or borrow against the equity, then this structure most likely won't work. SMSF borrowing aims to pay down the debt and accumulate for your retirement. Ultimately, the more you accumulate, the better your retirement income will be and the more secure you will feel. The most suitable commercial property will most likely be a set and forget investment that you set aside for your retirement. Whilst having a stable and secure property is important for any purchase, it's particularly important for a self-managed super fund because you want it working in the background all the way up until you either sell and upgrade or retire. This is why commercial property is an excellent choice for self-managed super funds. So, what sort of properties should you buy? Well, you have the options as you can buy office, retail, industrial properties. The main rule for any investment you purchase is that it satisfies the single acquirable asset rule. This means that the property would only be used as one asset and cannot be split up. Basically, the lender wants to see one property with one title on one lot. The ATO does give examples of what doesn't qualify when you buy using an LRBA. For example, you cannot purchase a vacant block of land and then build. You also cannot purchase farmland that has multiple titles, and these would be able to be split. Of course, this only applies if you're borrowing money. If you're using cash, then you can just about buy anything, with some exceptions. Additionally, any asset you purchase needs to meet the government's sole purpose test, which means the investment provides retirement benefits to members. This means that other than increasing the fund's balance, assets cannot benefit members before they retire. So, for example, you cannot use an SMSF property as a holiday home. However, under current rules and regulations, your fund can buy your business premises and then lease it back to your business. With the added tax benefits, this would be an opportunity for you to be your own landlord. Whilst you can set your own rent in this case, there are clear rules that you need to be paying fair market rent for your business. You can't just charge yourself nothing. Ultimately, whatever property you decide to buy in your self-managed super fund, it's about value and longevity. You should focus on a solid property in a good location that is easily tenantable. Over time, it should appreciate in value whilst the rent pays down the debt and provides a passive income. SMSFs are all about accumulation for your retirement. Buying in this structure is a long-term play and another way to reach financial freedom. And that's it on self-managed super funds. Enjoy the next lesson.